Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to a comprehensive problem for ratio analysis. We're going to have both a balance sheet and an income statement on which we will be calculating the ratios, grouping those ratios into the categorization of profitability ratios, asset utilization ratios, and liquidity ratios and debt utilization ratios. Get ready. It's time to take your chance with corporate finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we're going to select this item up top. We're in the 346 Comprehensive Ratio Analysis tab under the Practice Problems section. Closing this back out, we're going to go through all of our information up top, and then we'll show components or take components of that information as needed to work through our ratio analysis. The components that we will be using or the data we will have will be the financial statements, including the balance sheet and the income statement. Balance sheet is as of a point in time, income statement being the time frame, balance sheet where we stand, income statement the performance statement. So we've got the balance sheet, which include the assets breaking down into the current assets, and then the investments, then property, plant, and equipment to get to the total assets. Then we have liabilities and equity, including current liabilities, long-term liabilities, and the total liabilities, and then the stockholders' equity down here. Then, of course, the total liabilities and stockholders' equity equaling the total assets up top. Next, we've got the income statement in our standard format that we've been working with, that being sales or revenue up top minus the cost of goods sold, gross profit, then the selling and admin expenses to get to our operating profit, minus the expenses to get to earnings before taxes, minus the taxes to get to the earnings after taxes, otherwise known as net income. We're going to shorten that information here so we can see it a little bit more easily as we go through our data. Balance sheet, here's the balance sheet, basically the asset side of things. Here's the liabilities and equity side of things. Here's the income statement. All right, so we're going to go first through our profitability ratios. It's useful to be able to categorize these ratios as well because in practice, this is why you would use the ratios for calculations of profitability within these categories. And if you had taken a test question, they might ask you, the categorization of ratios or how these ratios might fit. They might do a matching question to fit the ratio into the proper category. So in any case, profitability ratios. We got the profit margin percent. We're going to have the return on assets, ROA. We've got the return on equity that we will be working with in this category. So let's go back up top. We're going to be calculating then the profitability, the profit margin percent. So let's take a look at that. That's going to be the earnings after taxes, net income. This is going to be our income statement number. Bottom line of the income statement, 114,000. That's our performance number. We're comparing that to the top line of the income statement, sales. Top line of the income statement, sales. You might see it calculated as net sales. Don't get confused with net sales as opposed to net income. Net sales means net of any kind of contra sales accounts, such as something like discounts, which is really a contra sale account. So really we're talking, sales number. Okay, so we're comparing the bottom line to the top line there. Let's pull out the trusty calculator and do the calculation. I'll try to calculate for them just so we can take a look at rounding and making things a percent and that kind of stuff. So we're going to make this one a percent. That means we're going to take the 114,000 divided by the 206,000, moving the decimal 2 places over. We're going to have to round it, of course, 5.53 about if we make it into a percent. What does that mean? That means for every dollar sale that we have, on average, we're keeping about 5 cents or 5.53 cents, or for every $100 sales that we have, top line of the income statement, we're keeping about $5.53. Is that good? Depends on past performance, industry standards. So in other words, some companies might have higher profit margins than others. That doesn't necessarily mean they're better because you also have to think about the quantity of sales, how much they're selling. So if you have a lower profit margin, then obviously you would need higher sales volume and vice versa. So here we go, the return on assets, which also could be called ROA, which is closely related to ROI, because if you think of the accounting equation, we're talking about what the company has in terms of assets. Why does the company have assets? Because that's what's been invested either through taking out a loan or through equity accumulation or equity investment by the owner. That's what we have that we expect to get, a return on, the return being shown on the income statement. So we have these assets. We want to use them to generate the return on the income statement. So the income statement, earnings after taxes, is the 114. That's the net income in essence. Net income divided by the total assets. So net income divided by total assets. We have now an income statement number up top, balance sheet number down below. Timing difference between these two, income statement being a calculation for how we're doing over time, whereas the balance sheet is as of a point in time. Therefore, you might see this as beginning number plus the ending number for total assets divided by 2, or average total assets is what they would typically call it. That would be the most common type of average, so just be aware of that. Depends on what problems you're working at, what will be the convention that you will be using. So let's take a look at this. We're having a measure of how efficiently we're using the assets. That's going to be the 114,000 divided by the 948,200. If we move the decimal point 2 places over, we've got the 12.02% about. Once again, a measure of how well we're using our assets. Is 12.02 good? Well, it depends on past performance. And obviously, we would like this number to be increasing. We would like it to go up because we would like the earnings after taxes to be increasing as compared to the assets, meaning we'd like to be able to increase a higher return with less asset investment. And you might say, well, don't I just want to accumulate assets on the balance sheet? No, you don't really. That's not really the goal, is to accumulate assets. The only reason the assets are in the business is to generate revenue. If we had assets that had no purpose in the business, they're not generating any revenue, we'd probably want to give them to the owner in the form of dividends so that they can then invest them somewhere where they can get a return on it. So in other words, if we can get the return, a same return for less assets, then that would typically be good. So we'd have to compare it to past performance and industry standards to see how good the 12.02 would be. Also note up top for the profit margin, we typically want the profit margin to be higher as well. We'd like to be making more money per, per sale that we have. If we could do so and still keep the volume of sale up. So then we have the return on equity. Next calculation, return on equity, which is going to be the earnings after taxes. That's going to be the income statement number that we're going to be comparing to the total stockholders' equity. So we have a performance number once again, and then we're going to compare that to a balance sheet number as of a point in time. Two differences in timing measurements. Therefore, you might see this as net income or earnings after taxes divided by average assets, most common average, beginning of the period plus end of the period, divided by 2. Now, thinking about this ratio, note, if you look at the accounting equation, it's assets equal liabilities plus equity. Assets is what the company has. The liabilities and equity are who have claim to it, either a third party or the owner in terms of equity. In other words, you can think of it as, how did we get these assets? Either we accumulated equity through earnings or the owner put money in through equity. So this is the owner's portion, or we financed it. We took out a loan and got the assets. You can rewrite this as assets minus liabilities equals equity, showing that equity is basically what the owner put in or has accumulated upwards that hasn't been taken out yet. And then think about our return on basically the owner's investment. So this is the net value of the company, earnings compared to that. We once again would like this to be higher because we would like our earnings, the income statement numbers, the returning on earnings, to be high as compared to the equity investment, what the owner has put in to achieve those earnings. In other words, if we can have less earnings, equity, and generate the same earnings, then that would be less that the owners basically have on the line, and they can generate the same earnings. You do, however, need to be careful about this ratio and the amount of leverage that is here, because one way to lower the stockholders' equity would be to increase liabilities. Right, liabilities as compared to the equity contribution in there, and you got to think about, well, how leveraged is the company? So you have to, of course, look at all these ratios in a complete picture. So if we then take a look at this, we're going to say, all right, all these ratios again are just one piece of the pie. You have to look at all, multiple ratios to really see what's happening, and you also really want to get good at looking at ratios and seeing when somebody is giving you half the information, which people people can do with words, they can do with numbers. People don't understand numbers as much, so they often think that numbers in and of themselves are deceiving, whereas words are not, because people tend to see when people are withholding information with words. They're getting better at that. With numbers, it's a little bit more difficult, but it's the same thing. If someone gives you partial information and tries to take action on that information without disclosing, all the facts, then you don't have all the information to make a decision. If someone gives you one ratio and tries to say that that's the whole story, then they're probably not giving you all the facts. And we want to get good at basically seeing how that could be, right? And then look for the facts. All right, so we're going to have 114,000 divided by the 603,000, and that's going to give us, if we move the decimal place over, 18.91% about. So once again, we would like this number typically to be increasing, but being wary of how much leverage is in the company, how much debt is in the company. Now we're going to go to the asset utilization ratios. Asset utilization ratios include the turnovers. So the turnover ratio. So we got the accounts receivable turnover. We've got the average collection period. We've got the average, we'll calculate the average collection period again. That all relates to the accounts receivable turnover. Inventory turnover, and then the fixed asset turnover, the total assets turnover. Okay, and then you could think about this as basically the total asset turnover being like the summary calculation here, because now we're looking at the total assets, and then we could break that total assets down into the factors, meaning fixed assets, inventory turnover, and the accounts receivable turnover. Okay, so let's start kind of from top to bottom in essence with the accounts receivable turnover. So we're going to say accounts receivable turnover calculated as sales. So now we're looking at the top line of the income statement. So sales is kind of like our objective. We have assets to generate sales, and we have expenses in order to help generate, sales. So the net income is the bottom line of the income statement, how we did after the expenses we consumed in this time period. Top line being the sales, how much sales we made, how much revenue we have generated in the time period. So sales income statement number compared to accounts receivable net. Accounts receivable net on the balance sheet. Note that we have an income statement number and a balance sheet number. Therefore, you might see this as sales or net sales. Don't confuse that with net income. And divided by average assets, most common average, beginning of the period plus the end of the period, divided by 2. It just depends on the context of the question to know whether they're asking for the average or not. So then we've got the accounts receivable. Also note it says accounts receivable net on the balance sheet. What does that mean? It's net of the allowance account, meaning you could have a contra asset account that's going to give you the amount of the accounts receivable we believe is uncollectible. In other words, if you had accounts receivable of 200,000, we might say, hey, there's some portion of that receivable that may not be collectible based on past performance. We're going to show you that now, and then we will take the net of those two items. So this is the amount that we expect to be collectible of the accounts receivable. All right, so then that's going to give us our turnover, accounts receivable turnover. So let's do that calculation down here. We're going to say that will be then the 206,000 divided by 178, and that's going to give us our 11.57. We typically want this number to be higher. All these turn ratios we want to typically be higher. Why? Because we want the sales to be increasing. Obviously, that's the point. We're trying to increase sales. That's increasing performance. And then the accounts receivable, we would like it to be lower as relation to sales, because that would basically mean that we're turning over the receivables faster. That means that we're collecting on them faster. If we got accounts receivable going up, that means that we're having sales that we have not yet collected on. And the longer that they're in the collection, the less our cash flow is, and the more likely we won't be able to collect on it. So 11.57 times is the amount of turns in the period. That's kind of an abstract number. Is that good or bad? Well, because it's a little abstract to us, we have to think about basically comparing it to past performance, comparing it to industry standard, and comparing our trend analysis over time to that of the industry standard. We can break this down, however, to the average collection period, to like a daily, how long accounts receivable are outstanding. And that could be a useful number in and of itself, because it usually is a little bit more concrete to at least people when you're presenting This is how many days basically the receivables are outstanding. We need to make that go down, right? A couple ways we can calculate that. We could take the days in a year. Note when you have the days in a year, you might see 365, which is a more accurate, more close to the days in the year for most years. Or you might try to standardize the months, which is often done in statistical analysis because we would like to have even chunks of things. So you could standardize the month by saying 12 months times an average of 30 days, which would be 360. So we're going to use a 360 here. Note that you might see 365 for those reasons. Depends on the context of the problem you are working with. Then we're going to take the receivable turnover, which we calculated up top, the 1157, and we'll just simply divide that out. So we'll take the 360 divided by the 11.57. That's going to give us the 31.11 days about. And you can see how we can present that a little bit more easily to people that aren't, statistical people that don't look at this stuff all the time or aren't comparing it to industry standards. So we could say, hey, look, the average receivables about, 31 days outstanding. We'd like to knock that down. May not be bad. Depends on the industry. That seems fairly good, but in any case, you could knock it down. If you knock it down that would increase cash flow and make it more likely that you would be able to collect on the receivables. We can also calculate that by taking, we're going to get to that same 3111 by calculating the average collection period by taking the accounts receivable, and that's going to be the 178. We're assuming the receivables are all sold on account, meaning we're not having cash sales that are all going through accounts receivable. We're sending out invoices and collecting on them at some future point. Then we can take the sales per day, calculate the sales per day by saying, hey, let's take this total sales number. That's going to be this item here on the income statement, and then dividing it by the number of days in a year. Once again, averaging 12 months times 30 days to get to the 360. So if we take this 2,060,000 divided by the 360, we would have an average sales per day of the 5722. That would be our average sales per day. Now, if we took that and then took our receivables divided by the average sales per day, then we're going to take the 178,000 divided by the 5722, where that's another way we can get to this 3111. Now, this way, I think to a lot of people might be more intuitive to do it this way. So just note that if you're trying to think about the average collection period, you might say, okay, well, let me take the sales that we're going to have on account are going to go through accounts receivable, divide them by the number of days in a year. That means we have average sales of 5,722. And if we take the accounts receivable and divide it by the average sale, then you could say they're outstanding for 31.11 days. And so that would be more intuitive to me. But note, you have to understand it up top this way as well, taking the receivable turnover, the days divided by receivable turnover. You just kind of have to memorize that until you just kind of understand it, because a test question might give you this information, number one, and two, if you understand the relationship between these ratios, then it's going to be easy. You'll just have a better understanding of what they're telling you to make better decisions on them. So then we got the inventory turnover. Note that the inventory turnover might be using sales or cost of goods sold. That depends on the context of, again, the question that you're going to be working in on. We'll talk about that and we have talked about it in a prior presentation, so I won't go into that in detail. Just note that we're going to have the sales item, which could be cost of goods sold if you're looking at depending on the context. And then we're going to divide that by the inventory, noting once again, we're taking the income statement number, top line of the income statement, divided by a balance sheet number. Therefore, you might see this as net sales divided by average inventory, which would be beginning of the period plus the end of the period divided by 2, if that was the case. And then we have the inventory turnover being the 6.98. So that would be the 2060000 divided by the 295,000. That would be the 6.98 about. Once again, we would like this to be higher the better, because we want our inventory to be turning over more, because that would be increasing the sales item, and it would mean we'd have less inventory costs of us holding on to basic inventory. So we'd want the inventory to be rotating through while still having enough inventory in case there's some kind of issue, like an increase in sales volume. So you got to balance that out to some degree. So there we have the 6.98. Is that good? Depends on industry standards. So we'd have to compare that to industry standards in terms of itself and our past performance and trends for ourselves compared to industry standards. Obviously, if we have the sales number here, we want that to be going up, and we want the inventory. If the inventory stays somewhat constant, then again, that would mean that we would be rotating the inventory through more efficiently, as opposed to having a stockpile of inventory that we're having to hold on to at that point. But again, there's a give and take, that you want some cushion there, of course, instead of having complete just-in-time, maybe depending on the just-in-time system, selling the inventory right when you have it ready, so that you're set up in case there's some kind of problem or some increase in the inventory sales. Then we got the fixed assets turnover. That's going to be calculated as sales, once again, like these terms are, top line of the income statement, compared to the fixed assets, which you could think of as property, plant, and equipment, PP&E. They could be called depreciable assets. We're comparing to those long-lived assets, trying to see how efficiently we're using our property, plant, and equipment. So if we divide this out, we are going to say that we have the 2060000 divided by the 339000. That's going to give us our 6.08 about, if we round this out. Once again, we would like to have this higher because we'd like sales to be increasing, and we would like to have sales increasing with basically the same amount or less property, plant, and equipment. Meaning property, plant, and equipment are things like building equipment, forklifts, and whatnot. If we can have less of those things and still be generating the same amount of sales, then that would be great, because then we'd have less of this long-term kind of capital investments type things that we're kind of tied into in order to generate the sales. So is that a good number? Depends on past performance, industry standards, and trends that we have versus the industry. Also note, once again, you have a sales number, income statement number versus a balance sheet number. This number is being drawn from here and here. And so you might see this as net sales divided by average fixed assets, or average plant assets, or average depreciable assets, property, plants, and equipment, just depending on the context due to the difference in timing between the income statement and balance sheet. So then we're going to have the total asset turnover. Remember, this is kind of like the overarching turnover now, because now we're comparing total assets to the income statement sales number. So now we got total assets, which is going to be the 2,060,060 sales divided by the total assets. Now, once again, we've got the sales number, income statement number divided by balance sheet number, the total assets. Therefore, you might see this as net sales divided by average total assets, depending on the context of the question. That's going to give us our total asset turnover. So the total assets are being drawn here. Sales we've seen multiple times on the income statement, 2060000 divided by the 9482. That's going to give us the 2.17. The 2.17. So once again, that 2.17, you can take a look at the other ratios in kind of conjunction. And when you look at the trend analysis, you can kind of look at the total asset turnover and all the related terms within it. Once again, you want this number to be higher. Higher would be better, because obviously we want the sales to be going up. We would like sales to be going up with less assets. Remember that we have the assets there in order to generate revenue in the future. The assets that are there on which we're able to generate sales. So if we can increase sales and have less assets, then that would be good. If we can keep the sales high where they are, increase them with fewer assets, because again, the assets aren't there in order to in order to just compile assets. That's not the goal. The goal is to generate revenue. If the company's not generating revenue, if there's no purpose for those assets in the company, then we would like to give them to the owners, who can then put them somewhere where they would be generating revenue. So the idea here is that we want the assets to be generating revenue. Now again, note that doesn't mean that we don't want some cash here. And you might see some companies have huge stockpiles of cash and whatnot. We want to safeguard against problems within the company and whatnot. But the goal here, and that would be for future revenue generation. If you're safeguarding against a catastrophe that happens in the future, or that could happen, you're hedging the risk. Then you're working to have future performance be better, right? But the goal here is to have the assets for some type of performance, and if they're not, then to give those possibly to the owner in terms of dividends. Okay, so then we have the liquidity ratios, including the current ratio and the quick ratio. These are the most common ratios, probably some of the first two that people will learn. Oftentimes when people look at ratios, they're thinking about in terms of, can we pay the bills that are coming up soon? And that's what a bank would be concerned with. Can they pay the obligations that are coming up soon? And remember, when we think about that, we're comparing the current liabilities. Those are the obligations coming up soon on the balance sheet, because those are going to be due within the next 12 months. Can we pay those? That's one of the most pressing, concerns we want to make sure that we can do. Well, how can we do that? Well, we compare one way, so we can try to compare the current assets to the current liabilities. So the current assets are going to be the assets that are more liquid, including, in our case, the cash, the marketable securities, the accounts receivable, and inventory. So those are going to be the things that hopefully will convert to cash soon, or that we're going to consume soon. And we're going to compare that to the current liabilities, which are the debts that we have to pay within a year's period of time. So if we do that comparison, let's take out the trusty calculator. We're going to say that we have the 548,000 divided by the 185,800. That gives us the 2.95 about. That means that we could pay off the current assets, we could pay off the current liabilities 2.9, almost 3 times over with the current assets. So that would be, now this ratio you can compare to industry standards as well to see what an industry standard is, but there is obviously we want this one to be basically over 1, because if it's not over 1, then we're looking, that means that our liabilities would be greater than the assets, which means that we would have problems paying off the current liabilities, you would think, right? So you'd want to be greater than 1. If you're talking about a bank or something like that, they may have different standards for different industries as well for that. But across the board, it's, you'd think it had to be greater than 1. Now you might say, look, you've got these current assets, but then you're including things like inventory. What if there was some kind of crisis and the market goes down? You're not going to be able to sell the inventory, or if the inventory becomes obsolete or something. So a bank will then make a more restricted ratio, or we might make a more restrictive ratio as management to consider that situation. And we'd say, okay, well, let's take the quick assets, or the acid assets sometimes called, which you can calculate as, in our case, the cash, 52,000, marketable securities, because we can typically sell them out if they're going to be, short-term securities and investments like stocks and bonds. And then we have the accounts receivable, which hopefully we'll collect on them because we've already calculated the amount of the allowance that is uncollectible. So hopefully we'll pick up most of them, and we won't include inventory. So that's going to be the 253. You can also calculate that as current assets of 548,000 divided by minus the inventory of 295,000. That's going to give us the 253. We're going to be comparing that then to the same liabilities that are still the same liabilities that are going to be due within a year, meaning the current liabilities. And that's going to give us our quick ratio, sometimes called an acid ratio. So that's going to be the 253,000 divided by the 185,800. And that's 1.636 about. Now this ratio will always be either equal to or less, almost always less than the current ratio, because unless we had if we have no inventory, then it might be the same. But if we have inventory, it's always going to be less, and that's the point. It's supposed to be more restrictive, meaning if we took out inventory, we could still pay off the liabilities 1.36 times over, even if we couldn't sell any of the inventory in the next 12-month time period. So once again, you would think that you'd want this ratio generally to be over 1. Usually, but you'd want to be comparing it also to the industry standards. Obviously, from a banking standpoint, the higher these numbers are, the more safe the bank feels that you can pay off your current obligations, and therefore the more likely they might be to loan you money with the liquidity ratios. Next, we have the debt utilization ratios. We're going to include the debt to total asset ratio and the times interest earned ratios here. So we're going to say, all right, debt to total assets, it's exactly what it sounds like. We're going to take the liabilities, the debt on the balance sheet here. So we got the total liabilities, including the current and long-term liabilities here. And we're going to compare that then to the total assets. Now, if you think about the accounting equation, assets equal liabilities plus equity, we're comparing the liabilities, basically the amount, you could think of it, the amount of the assets that are claimed by the liabilities, or the amount of the assets possibly that we were able to accumulate due to debt, due to taking out a loan. We're comparing the debt compared to the total assets. Notice that if you compare the debt to the total assets, then you can also figure out the equity to total assets, right? Because the equity to total assets represents how much the owners basically have claimed to compared to the assets. So if we think about debt to total assets, we're going to say, all right, debt to total assets is going to be the liabilities divided by the total assets. So here's the total assets. Here are the liabilities. If we divide that out, we're going to say the 345.2 divided by the 948.2. Moving the decimal 2 places over, we're at 36.41 about. Now, if we know that we're at 36.41 here for the debt, if I subtract this minus 1 or 1 minus that, 63.6%, about 64% or whatever, would be the equity portion, right? Because it would be 100 minus the debt portion here. So you're kind of figuring out how much of the total assets are allocated to the liabilities versus equity on a percentage basis. Now, this is the one that's a little bit confusing because people will analyze this and have different opinions as to how much debt would be good. Because notice debt can work for you and against you, because if you're thinking about the assets here, you're going to say, well, I'd like to limit the amount that the owner has to put in and still get a return on it. And I'd like to increase my assets because the more assets I have, if I can get a return on the assets in the business, I would like to have more assets to get a higher return. So you could say, well, it would make sense then to increase the liabilities so that the owner doesn't have to put their own money in, and we increase the assets that would help us to get the return. And as long as we can pay off the interest rate for it, then we would be increasing our return, which would be better. But of course, then at some point in time, you're going to get to a point where you're saying, all right, well, now if liabilities are a really large portion of the assets, then you get into a point in time where you're maybe over leveraged. And if you are over leveraged and there's a crisis, there's a problem that happens in the market just goes down, then you might be in a situation where you're not generating the sales on the assets anymore, and you may not be able to pay off the interest on the debt or whatnot. You may need a loan, and you may not be able to take a loan at that point in time, considering the fact that the market is down and you're already leveraged. So there's going to be a trade-off between people's arguments on how high the leveraged amount should be. So you'll have different arguments on that. Just note that typically, from a banking standpoint, if they were to give you a loan or something like that, the higher this is, the worse it would be, right? Because this is the debt, the amount of the assets claimed by existing debt. So if they put out more debt, then so that would be there. So you'd want to compare this to basically industry standard once again and to past performance. Then we have the time interest earned, and you can also see this from kind of like a banking standpoint. If they're thinking about loaning money, then they're going to think about, well, just like if you were going to rent someone a building, your question is, can they at least pay the rent? Can they pay the rent? I want to make sure they can pay it. If you're renting someone purchasing power, meaning renting them money, meaning loaning them money, the question is, can they at least pay the rent on the money, which is called interest? So we're going to see how many times over could they pay the interest on the money. So for that, we're going to take the income before interest and taxes. That seems a little bit confusing, but let's just break it down here. If we've got the earnings after taxes on the income statement, that already has been deducted by the interest expense, and taxes kind of muddies up the water because that's deductible for interest expenses. So what we're going to do is we want to remove the effect of the interest and taxes so that we can then divide in interest to see how many times over we can pay the interest. So to do that, we have to pull the interest out, and we're going to pull the taxes out because taxes are just messy in general. So we can do that two ways. That's going to bring us back up to the operating profit in the case of our multi-step income statement because of the way it's formatted. But notice we could have more than just interest in this category down here and whatnot. So you'd probably want to make sure that you're calculating it this way. You take the net income, 114,000. You're going to add back the taxes, which is 73,000, and then you're going to add back the interest, which is going to be this 30,000, which once again, in our case, brings us to this operating profit of the 220,000 because of our multi-step income statement. So we got the 220,000. We're going to compare that to the interest expense, the rent that we spent during this time period on the money we purchased, 30,000. And so if we divide that out, we're going to say, okay, how many times over could we pay the interest? 22000 divided by 30,000, we could pay it over 7.33 times. Again, from a banking perspective, of course, they want this to be higher the better, because that would mean you're more likely to be able to pay the rent on the money, and they'd be more likely to be giving you a loan to get the rent on the money.